You're watching us here on Trading Hour. I'm Mangalam Malu. With me is Reema Tendulkar. In case you've just joined in, the important news of the day. The Reserve Bank of India has cut interest rates or repo rates by 25 basis points for the first time in the last 5 years, though they've maintained their stance, and the announcements around liquidity were also fairly calibrated, much against street expectations of a lot more liquidity to be given. Seems like the RBI is balancing out its action with commentary itself. The MSF rate, etc., have adjusted on account of the reduction that we've seen in repo rates. What has the market made of this? Well, not too much on the good or the bad side. The Nifty is marginally in the green after ending marginally in the red in yesterday's trading session. The Nifty Bank was marginally in the green yesterday and now is marginally in the red. The good part is the mid-cap index is doing a lot better as stocks are coming off the lows that they hit yesterday. I'm Mangalam Malu, with me, Reema Tendulkar. Hi, Reema.
Hi, I think the two key words from the RBI this time is one is flexible and the other one is forward-looking when it comes to inflation targeting, because that sets the stage for, Sanjay Malhotra's, term as the RBI governor. And economists are quick to point out that perhaps in April also a rate cut is coming. But finally, I think, Mangalam, we can say thank God it's Friday, right? Like, this has been a long week because it was a continuation of last week, the budget in the middle squeezed in. So finally, done for the week.
Notwithstanding the results, the slew of results.
Especially on the consumer front. Yeah, a lot on the consumer front. But we're wrapping up this week. Well, you've still got about 4.5 hours to go. But we're counting down. And for the week so far, it's been a gain of close to about 0.5% on the benchmark indices. Banks are soft today. The Nifty Bank is down about 0.2%. But for the week, it's already clocked in about a 1.5% gain. Ajay Srivastava, Managing Director at Dimensions Corporate Finance Services, is with us on the show as usual. He always joins us unfailingly on Policy Day. Ajay, your first words, wise words?
Good morning. I have no wise or unwise, but he has done what he was brought here to do, is to give this symbolic cut. I think we all knew the RBI governor, the X1, did not want to push in, which is very correct decision. There is no reason to have pushed in a very symbolic rate. It's not that the banks are going to cut down the interest rates of anybody at this point of time. It's not that the people who want to put money into the bank as deposits are going to be happy if they cut down anything. So I think it's been a pure symbolic gesture if you ask me to say, okay, we want to cut down the rate. Now, why do we want to cut down the rate? Because inflation has not gone down. The liquidity situation is tight in the market. The rupee, the parity with the US interest rate is worse compared to last year. So if you look at the parameters of why he's done it, I think the whole market knows it's symbolic. Okay, let's push one more button and see if the growth comes in. But I think, we are more focused on the results which are coming through. We are more focused to see what's going to happen to the rupee dollar gap, which has now opened up for people who borrowed in foreign currency. And largely speaking, as you see, the market is very, very indifferent to this 25 basis point, because I don't have a terminal right now here with me, but I don't think the yields have gone down at all based upon this rate cut. So, well, symbolic rate cut, be happy that there's so-called rate cut, but nothing much will change in terms of stock market, my friend. Results will still count, and what happens in the US and the Europe markets is going to make a difference to us. So it's not going to bring FIs back in a hurry, certainly. That's the problem.
Yeah, Ajay, thank you very much. I wanted to stay back to understand from you, how you understood the policy. Thank you very much for that excellent wrap. And your point about yield is well taken. It was at 6.65 before the policy cut. After the policy cut, it went to 6.69 because the expectation was maybe he will say accommodative stance. He didn't. He only gave a cut. So it's exactly where it was yesterday, 6.69, the 10-year bond yield, that is. But, if you can tell us how you will interpret it as a bank investor, in case you are holding a bank share, how would you look at it? On the one hand, the repo cut will mean the external benchmark loans will have to be marked lower. So there is about a 5 basis point drop in NIMs for most of the banks. But the governor is also promising more liquidity. He has told them that he is happy with the credit deposit ratio. I mean, in approximately those words. That is, you don't have to, scrounge on credit anymore. He's also said that he wants them to lend actively in the call. So regulation should not be all about prudence. It should also look at the efficiency cost, giving the impression that the LCR is definitely pushed out. It will not start on April 1. Is all this making you bank positive?
I think the fundamental flaw in all this, Lata, is that people who invest money in capex, in the private capex, look at 0.5, 0.25% interest to make a differential to the project. They don't. Believe me, they don't. None of them look at it. Yes, interest cost is relevant, but interest is a very small percentage of your capex cost of any large project at this point of time. What they need for is the demand will go up. What they need for is there is a requirement of credit in the market. That's where banks' fortunes are made. Now, we all know the story of unsecured credit. That segment is gone. We all know the story of mid-cap companies. Most of them, a good part, have raised equity in the last 2 years, which the QIPs are coming through, the IPOs have come through. Requirement of bank loans has gone down in the system of the credit-worthy bank who could have been lent the money to. Banks have a fundamental problem. They got people who want to borrow who they don't want to lend to, and the people who they want to lend to don't want to borrow from the bank. There's a fundamental, and it's a spin-off of what happened in the equity market. Our companies capitalized it so well.
Okay, may I ask, just as a counter, I agree with you that a large part of the unsecured loan constituency is hurt, but there is one borrowable constituency which has now 1 lakh rupees more in its pocket because of lower taxes. So while capex cycle may not have started off in the way in which one would like it, the retail borrower has more, the potential retail borrower has more money in his pocket, and therefore instead of taking an EMI of 90,000, he can take an EMI of 1 lakh, because there's 10,000 more rupees by way of tax giveaways. As well, banks have been told to lend. Credit deposit ratio is fine, is what the governor is saying. And he's saying that we will give more liquidity. The neutral question is, what is your attitude to banking stocks? Are you attracted to banking or NBFC stock now?
For the last 2 years, we've told you we have not held a single bank stock. We don't hold the banking index at all, zero. And the reasons we just outlined is, and I will not buy the bank stocks again for the same reason. 3 reasons. 1, whom you want to lend to don't want to borrow. Number 2, look at the number of banks compared to requirement. The competition is severe for the good quality names, and therefore it's very difficult to make money in the market. Maybe the banks which have got subsidiaries, which is insurance, mutual fund, etc., will do better. But a pure banking company today really has no way to generate value for your shareholders compared to many other segments of the economy. So for an investor, I think banking still remains a no-go territory as far as we are concerned. Nothing has changed in the whole scenario as far as we are concerned, and therefore their ability to give you shareholder return excess of 15-18%, Lata, is very difficult. The growth rate is 6.6% as the RBI has already mandated. So, how do you generate superior returns for a banking company at this point of time? If I sell some product, maybe I can. But money back, commodity money, I doubt it is the place where you're going to make money for the next year or so. I may be wrong, but 2 years it has done us well. Maybe next 1 year also, banking will become a problem area. The problem with interest rate cut is the borrowers now start expecting and saying, listen, why can't you cut it? The RBI has cut interest rate. The guy who's lending the FD guy is saying, listen, I'm not going to give it to you. I'm going to go to the X bank who's going to give me a higher rate. So banks are now caught in a worse jam. The borrowers want it to be lower interest rate, and the depositor saying, if you don't give me the same rate, I'm going somewhere else. Imagine the plight of the bank. Okay. Not a good place for shareholders, right?
Okay. From a shareholder angle, my final question, I'm being very unfair to Malu. I know he's bursting with questions himself. If you take a combination of the budget and the monetary policy, do real estate stocks become attractive? Do consumer durable stocks become attractive because of the BNPL, uptick that may come?
See, real estate stocks have peaked, and I think real estate prices have peaked in the market. Just like any index peaks, all these things happen. 1 lakh crore, 100 crore flats will get sold, and so on and so forth. Just like what happens in a stock market, all of us buy at crazy P's or hold on to the stocks. Real estate sector is in for a correction for the simple reason it's too overbought. Too many investors sitting in real estate, actual holding who will want to dispose it off. So if you look at the next 3-year scenario, what we have analyzed, there'll be almost 50 to 60% of real estate bought in the last 2 years will come back to the market to be sold. And you know what happens once the prices plateau in real estate? Everybody wants to sell faster and faster. So that's why we said real estate sector, not only for interest rate, leave it aside, but the reason is overbought by financial investors who will want to dispose of properties, squeezing out primary sales out of the market for the real estate developers. So it's peaked, my friend. Unfortunately, if you're still there, whoever gets out, if you're an investor in the share, you're good enough. But I think for the next 1 to 1.5 years, real estate prices, underlying real estate stocks have peaked and will show a decline in our view. Maybe wrong, but that's what our view is.
All right, we take that point, Lata. Thank you for those questions. A lot of them we thought of, you'd asked. We will wrap it up on just one note. You said that you are not looking at the RBI policy or anything. It's the earnings that matter the most. Of the earnings that have come by so far, what is it that you liked, in particular, any sector which you think is on the cusp of a turnaround?
I won't say turnaround because it's already grown up. I think the hotels have surprised on the upside to say the kind of resilience they're showing, and still the rates in the market are absolutely phenomenal. I think that's one sector which has given us a great comfort that for 2 years time frame, you are in a good sector by and large. As a whole hotel, 6-7 companies listed, so you don't have too many choices of that, but also means that the segment is fairly concentrated. So hotels is one. Aviation is definitely the second one, which has surprised to the strength. Yes, there is issues on rupee dollar, which will keep coming in, but I think the demand supply is going to be in favor of these companies. So aviation, hotels, I think is very good. Capex at this point of time has corrected dramatically. So MNC Capex companies, now perhaps the results have been good. As always in market cut down, everything gets sold. But I think the MNC Capex companies represent a phenomenal turnaround scenario for the next 2 to 3 years, in spite of government lower Capex, because they supply to a different part of the industry. And the last one is, I think, auto ancillaries. I think they will be doing well. And the final one where we have a large holding is commodities. With rupee at 88, 89, now they can price their commodities 5% higher than they could last year, even if volumes are same. And that all that 5% will go to the bottom line. So I think commodity companies, they are very few in this country, will reap a huge bonus dividend in the next 12 months. Nothing to be done, just thanks to rupee dollar.
Indeed, the weakness in the currency has made the domestic companies far more competitive. That point is well taken. Thank you very much, Ajay, for joining in. He likes hotels, he likes aviation. They've surprised him with the kind of resilience across the last few years. MNC Capex companies, and then you've got commodity names. Get into a break, and that gives us a cue to talk about commodities on the other side of this break with Manisha Gupta.
Welcome back. A couple of mid-caps doing extremely well. Yesterday, we told you about how ITC's cigarette volume growth surprised the street on the upside, right? Well, that stock is seeing a bit of profit booking, or perhaps, the sentiment of other things weighing down on the stock with regards to weak FMCG consumption, etc., is keeping that stock under pressure. The positive of ITC's cigarette volume growth is actually rubbed off on Godfrey Phillips. Over the last many quarters, some 8 or 9 quarters, Godfrey Phillips has actually grown faster than ITC when it came to cigarette volumes. So could that be the case this time also or not, is what the street is betting on. That stock up around 8% on a day when the mid-caps are doing a lot better as well. But the RBI policies done with the rupees weakened. What does all of that have to do with commodities? Manisha joins in on a roundup of that. And Manisha, you're also looking at gold.
Well, I am, yes. We've done an all-time high of 2880 an ounce, and we've come slightly off those kind of levels right now, but the markets are not really giving up because every decline has led to a buying opportunity in India and various other international markets as well. Well, the US president's aggressive trade policies is the major reason for that. And then the street is also looking at global central bank buying, which in the last 3 years has been above $1,000 and $1,000 tons rather. And if you look at the last 15 years, the global central banks have been net buyers in case of gold. The World Gold Council report also tells you that in 2024, the global gold buying has been at a record high. It has been up 1%, but 4,900 tons is what global markets have bought. And apart from that, there also was a Citi report overnight which says that they are preponing their $3,000 an ounce target for gold, and they expect the gold prices to hit 3,000 in the next 1 to 3 months itself. I also want to take you through on what various global central banks really have done in sense of revision in forecasts for their gold prices. When When you look at HSBC, Deutsche Bank, Macquarie, well, all of them believe that gold prices could be between 2,600 to 2,800 on the higher side. 2,900 is what ANZ has put it out as well. JP Morgan believes 2,800 to 2,900 is where the gold prices could be trading within. And then you have this complete bandwagon which believes $3,000 per ounce is in the coming, and that is Citi, Goldman Sachs, UBS, Bank of America, which believe that there is more steam left in gold and you could be looking at higher highs from here.
Well, 3,000 doesn't seem so far away when you're already at 28.64. Thank you, Manisha, for that. Get into a break. Before that, let's get you the Growth Code, a special initiative by Grow and CNBC-TV18 designed to provide you with valuable insights and strategies to navigate the market and make informed decisions. Today, we'll unpack the risks of speculative trading and the lessons learned in the aftermath of the infamous 2001 Ketan Parekh scam.
Speculative trading creates artificial demand and can inflate prices, often resulting in market bubbles. But one small prick and the entire illusion vanishes in an instant. Speculation is the reason 90% intraday traders end up with net losses.
Speculative trading dominates the market despite its risk is because of the lure of quick gains, lack of common sense, and there's obviously a lot of greed as well. Time after time we have seen this cycle repeating. Right now the money at stake is far higher and is of great concern at the moment.
The 2001 Ketan Parekh scam exposed the perils of unchecked speculation. Fueled by insider information and excessive leverage, Parekh manipulated stock prices to siphon off over 40,000 crore.
One of the biggest things that happened in Ketan Parekh scam was a kind of a narrative that got built. The hype was built so much that it ended up brainwashing the retail investors and traders. The biggest problem here was that while they were investing, the pump and dump scheme was happening simultaneously.
The crisis forced a reckoning, with the market regulator implementing sweeping reforms. Circular trading was abolished. A central fraud registry was created and stock options were introduced for the first time.
The scam definitely highlighted the risk of speculative trading and thereafter shifted the investors' focus to relatively safer and established companies. Investors became far more aware of the risks in speculative trading and the pump and dump schemes. Though the markets post-2020 also need similar kind of awareness.
While the scam helped correct systemic issues, traders also learnt about the risks of speculative trading. Learnings from the Ketan Parekh scam helped India build a stronger, more resilient market.
Welcome back. Bharti Airtel is the top Nifty gainer, 4.5% higher on that, taking its one-year rally to nearly 50%. Quick positives in the numbers. One, the average revenue per user per month. This is basically the monthly bill of customers, and that's gone up 5% quarter on quarter and 18% year on year, and it now stands at 245. Remember, Sunil Bharti Mittal's aspiration is to take it to 300. We're at 245. Secondly, subscriber growth, which came down in the prior quarter because of tariff hikes, bounced back very smartly, 5 million added in Q3. Thirdly, the India mobile revenue. So on and whole, you take the revenues, you take the volumes, you take the realization or the ARPU, and revenues have gone up by 5.8% ahead of what peers have done. And also what the street is taking note of is that the price hikes took place in July. So Q2 and Q3 benefited from the price hikes, and we've seen a near 17% jump in the revenues, which basically means the entire benefit of the tariff hike has flowed through into the revenue. They've not lost anything due to down trading or just losing subscribers on the network. So that is a positive. The entire price hike seems to have been absorbed.
Take that point, and the stock is understandably up around 5% on that data. The other one on our radar is NCC. It's on the back of its third quarter numbers. Sudarshan, how did the numbers look?
So NCC has reported a weak set of earnings. It has missed EBITDA estimates by almost 10%. Margin has missed estimates by more than 100 basis points. But more than weak earnings, what has caught the attention is cut in FY25 guidance. Now, FY25 revenue growth now seen at 5%, versus earlier guidance of 15%, and margin is seen at 9.25% versus guidance of 9.5 to 10%. Also on debt level, gross debt has seen a sharp increase. As of December 2024, gross debt was rupees 2,400 crore versus 1,700 crore that company had reported as of September 2024, and it's because of the delay in one of the payments related to JJM. And after this, JM Fin has come out with a note. It maintains buy call but has cut target to rupees 330. Also, it has cut FY 25, 26, 27 EPS estimates by somewhere in the range of 12 to 27%. So weak earnings and guidance cut, and because of that, you are seeing a big fall in NCC.
Quite the accident of the day, 10% down on NCC now. But let's get to Upasana now for PG Electroplast. Stock is up 5%.
Well, the company's reported good set of numbers above street estimates, and mind you that the company has raised its FY25 revenue and profit guidance. Now, company says that the growth momentum in the product business continues to remain very strong, which has led to a strong performance, especially in the revenue. Now, company has reported a revenue growth of 82%, which was led by product business, which grew 1.4 times on a Y&Y basis. Now, company says that it is seeing a good momentum in RAC due to channel filling in the anticipation of strong summer season, and clocked a growth of over 1.8 times in Q3 FY25. Coming to the numbers now, revenue stood at 968 as highlighted earlier with an uptick of 82%. Gross margins expanded by 110 basis points at 21.6. EBITDA margins also stood above the street estimates at 8.8% with an expansion of 90 basis points. And lastly, PAT also saw an uptick of nearly 1.1 times at 40 crores. Now, coming to the guidance of the company for FY25, company has overdone a 7% upward revision in the revenue guidance at 4,550 crores now, and 12% increase in PAT guidance at 280 crores. For FY25.
All right.
So all in all, strong set of numbers.
All right, Upasana, thanks a lot for that. But Reema, Indus Towers is also something that you're watching.
There's news.
Yes.
So the company has acquired 16,100 towers from Airtel and Bharti Hexacom, and they'll be paying about 3,300 crore rupees for this. Now, Citi says this transaction is favorable for the company. One, because the capital will be used for the core operations. Secondly, the company will be funding this by debt. So it does not in any way change the dividend payout plans. Remember, the street is hopeful now that the Vodafone Idea issue has been sort of resolved. They're getting money from Vodafone Idea. The company will pay a hefty dividend of 18 rupees in Q4. So that thesis remains intact. And plus, according to Citi, valuations are fairly reasonable, which is why they have a buy call. So they've acquired towers, which is core competence for the company, and it doesn't change the expectation of a dividend payout.
All right, we take that point. That's Indus Tower up around 3%. But the accident of the day, the other accident of the day is BKG. Why is that? Because inflation's eaten away the bhujia. Why is that? Again, if you look at the numbers, 14.5% growth in the company's top line, but that hasn't done much for the bottom line. The EBITDA is actually down by 26%. Gross margins have compressed around 257 basis points. And the underlying volume growth is just around 3%. So what explains this revenue growth? The company had to resort to price hikes. Remember, there was a fair amount of inflation that we've seen in edible oil and potato, as well as besan, which are the key ingredients of the bhujia that the company makes. And we have EBITDA margins down from 12% to sub 8%, and the net profit on the back of that down 40% itself. So inflation eating away the bhujia, and that in turn eating away the returns on the shareholders, down 11% for that stock. But we take a short break, come back, put the spotlight on M&M and LIC ahead of their third quarter numbers. Welcome back. Let's put focus on the numbers then. Today, the big one from the Nifty is M&M, expected to release its third quarter numbers. Sudarshan joins in to tell us what the street expects. Sudarshan, we already have the volume data, and we also have the Vahan data that you painstakingly put out every month, much ahead of everyone else. Let's hear you talk about the numbers as well.
So if you ask anyone which are those two segments in the auto sector which have been performing well, and those two segments are in passenger vehicles, it's SUV, and second is tractor segment. So which company is the leader in both these segments? M&M. So you can see in the volumes, YOY for auto, volumes of M&M have increased by 16%, and for tractor segment, volumes are up 20%. So on the basis of strong volume growth, we are expecting a healthy set of earnings by M&M for Q3 FY25. Profit is seen rising 29%, revenue may increase by 21%, EBITDA too can see a rise of 37%, and margin may increase by almost 200 basis points. It may come at 14.5% versus 12.8% that company reported in the same quarter last year. Also, realization may see a rise on YOY, but sequentially it may see a minor dip. Now talking about the commentary, what exactly we would be looking in the commentary. First, what is the status on overall demand if there is an uptick in the last few months, and what would be the target for FY25, basically estimates for FY25. For tractor segment, considering the demand growth in last few months, if there is any uptick in the estimate for FY25. And lastly, for EV, recently the company has made launches for 2 to 3 new products. So how has the demand been panning out over the last few months?
Thank you very much for that. And this dominance in SUVs and tractors is really showing up in the stock price. 85% up in the last 1 year, 250% up in the last 3 years. And even if you look at a CAGR return over the last 5 years, which is starting the time of COVID, it's been a 41% stock price CAGR for M&M. But we will get into a short break on that note. On the other side, we'll invite the management of Gulf Oil Lubricants. The stock is up 5% post Q3 numbers. We'll get chatting. Welcome back. Gulf Oil Lubricants. The stock is now in an upper circuit, 9% only buyers, and the stock has crossed its 200-day moving average with the up move. Good numbers. Revenue growth up 6.5% quarter on quarter, nearly 11% on a year-on-year basis, and margins at 13.6%. Ravi Chawla, CEO and MD of the company, is now with us on the show. So for the 9 months, Mr. Chawla, you've done about an 8.5% top-line growth. Correct me if I'm wrong. You had earlier shared a guidance of 12 to 14% for the full year. So, how is Q4 likely to shape up for you? And can you achieve at least a 12% to 14% revenue growth for the year?
Well, for us, we try to grow 2 to 3x the market. And as you know, the last 6 months have been challenging. We are seeing, of course, some headwinds, but also some recovery happening. The macroeconomic conditions in Q3 have been quite challenging. But happy to share that, we are going 2x the market. And we have, as you reported, 8.5% in revenue. Our AdBlue, which was going slightly soft, is now picked up in the third quarter. And overall, I would say our growth trajectory is continuing to be good, as you can see in the Q3 results, which is an all-time high for us in terms of revenue and in terms of our EBITDA, which is 122 crores. So overall, the demand conditions, in spite of being slightly, coming back, I would say, but we've been able to do well. And we continue to 2x the market, at least in terms of our revenue and volumes.
All right, that's incredible. You've been guiding for 2 to 3x, Mr. Chawla, and now you've done 2x in tough conditions as well. So let's get some other details out as well. If you could give us a sense of volume growth in the third quarter, and also if you could break that down up for your consumer business and your industrial B2B businesses.
Yeah, so, we have 10% of our business which comes from factory fill, which is the new vehicles, commercial vehicles. So as you know, that is going through a bit of a, I would say, low in terms of that. So that has got impacted. If we take out that, we are actually growing close to 9-10%. And the balance 90%. And if we take our overall, our B2C ratio is about 55% and 45 is B2B. So that's intact. And if you look at that, yes, we've seen segments like, for us, the motorcycle segment is doing well. That's high double digit. And the industrial and what we call the infrastructure segment, these have started picking up again, double digit growth. So overall, I would say the factory fill has impacted us, but we are seeing some shoots coming in, and hopefully with all the the budget announced, middle class and others gaining, and we see the trajectory going up. And the fourth quarter for us is generally a strong quarter because we have, though we have achieved our highest ever, we hope that the fourth quarter this continues, and this is usually where our distributors and other such promotions end and a lot of push happens. And of course, the brand is also very strong. So distribution things come to play. And overall, our B2B businesses are doing well, and OEM is also going to pick up. So I think it augurs well in terms of our fourth quarter.
So what was the absolute volume growth for you in this quarter? And did you gain market share? Where does it stand at?
Yeah, so I forgot to mention it. You started with that. We did 38,500 in terms of lubricants, which is a 7% growth year on year. And this is the highest ever we have done. And sequentially, earlier used to be about 37,000 in most quarters, the best quarters so far, now 38,500. And I think that's the volume growth we have. And AdBlue also has picked up, I would say around 36,000 is what AdBlue is. So that's again a good growth for us, 13% odd. So overall, I think 13% year to date in AdBlue. So overall, good numbers coming in quarter three. And I think what we've also shown that how resilient our business model is in spite of the headwinds, and of course, happy to see early signs of demand recovery.
So 7.5% volume growth in Q3. Considering Q4 is stronger, what could be the volume growth in Q4? And also you've said exports have done well. What was the growth?
Yeah, so exports is quite high. I would say more than 20% growth in exports. And that's good for us. We're exporting to more than 25 countries for our 4 or 5 of our OEMs. And yes, 2x of the market. Whatever happens in quarter four, demand conditions are 3 to 4%. We are hoping we can do well on that and try to do better than that also.
What is the export contribution now? 20% growth, and is that sustainable, or do you see it with rupee depreciation? We should see higher growth.
So exports is mid-single digit. It's not that high in terms of volume, but doing well. And yes, good prospects on that. As we see the Indian OEMs going, and also a few other, we would announce a few more partnerships with OEMs for export shortly. So I think that also augurs well for us, looking at India as a good supply place also.
Where does your market share stand at right now versus the start of this year? Since you've been growing faster than the market, we just want to get that number out.
So normally, we have different segments, so it would be segment-wise. But as a benchmark, if we are growing 2x the market, we would generally gain about 0.5% market share, or 0.4, 0.3%. Certain segments, obviously, we try to do better. Industrials and others, we are less than 5% market share. So segments like diesel engine oil, motorcycle, we have higher share, close to 9-10%. And of course, amongst OEMs in the private sector, we are a lead player. So it varies, but benchmark-wise, if we are doing 2x the market growth, we would gain about 0.3, 0.4% market share.
Any price decision?
Yeah, sorry.
Any price decision taken in Q3, or you plan to in Q4?
Well, we have to wait and watch on the foreign exchange because we do import our base oil, and low crude we expect it to be steady. I think we have some adjustments we do in our trade schemes, etc. But we'll have to wait and watch the next couple of days to see what is going to be the impact on the forex.
Right. Are there any downside risks to your margins or any upside triggers? Because the downside risk would be your base oil being imported, and the upside risk would be premiumization along with the crude oil prices itself being range bound.
Yeah, so we've been saying 12 to 14%. Happy to share last quarter was towards the higher end. And of course, it's affected. We have a lag time on the increase in the base oil. Forex, of course, also impacts us. But we've also been focusing a lot on our premium product ranges, which are less than 10 today. But we are trying to grow that 2 times. So if we are growing 7%, we would like to grow 2 times that. And that's happening successfully. So I think it's a mix of managing that. But I think we are quite committed to the 12 to 14% band as of now. And of course, we'll have to wait and watch unless there's something which is going to really, but there's a lag time, and then the recovery also happens in the B2C market. The prices go on. Then the B2B business is more, PVC led and also contract led. So I think we are good for that 12 to 14%. Happy to do more, but obviously depends on the competitive scenario also.
All right. On your battery business, you were looking at around 300 crore in the next couple of years. Where does that stand at? And Tyrex as well. You were expecting to double that revenue and turn EBITDA positive. So what's the update on that before we let you go?
So on Tyrex, which is primarily into DC chargers, the fast chargers for the EV market, happy to share that, as you mentioned, we are looking at doubling the turnover and more. We are well on course with that, but it's they've got 8-10% market share, and we're happy to say we're 1,800 DC chargers installed. So we are on track to double that in terms of turnover, and obviously the market is going to grow. On the battery business, happy to share that again we are growing, but we do have the 300 crores. I think is more of a longer-term vision for us. We are at about, I think, around 75-80 crores annually on that. But last quarter has been good. We've also, we used to import most of the batteries. Now we are getting some local sourcing done. And that is a business which also helps us in terms of our synergy of our distribution. And that's really where we are. Right. And that's more of a medium-term vision, the number you gave. Yeah.
Take that point. Thank you, Ravi. Always a pleasure speaking with you. Wish you good luck for the remainder of this year as well. And 2 to 3x is your guidance, always above the market, gain market share and stay margins between 12 to 14%. Take a short break, get you more on the markets on the other side. Well, we are seeing some recovery for the Nifty right now, up around 50 odd points, 90 points up for the Sensex. Trent is one of the stocks which was under pressure in yesterday's trading session post their numbers, but now showing some bit of recovery from the lows. The auto pack is doing extremely well. So we have Bajaj Auto, M&M ahead of its numbers, as Sudarshan said, Hero MotoCorp doing well too. So we'll wrap up on this edition of Trading Hours. Stay tuned. Halftime report comes up next, but it's not just halftime report. You're also looking at the RBI presser or the press conference of the new RBI governor. We'll get you all that and more in just a bit.